Senior Market Analyst, IronFX. We're going to be going through practically FX pairs today. We had a number of financial releases yet. I would like also to have a look at US stock markets given the earnings season, and probably also have a look at WTI's price. Starting with the FX market, and first in our chart is Euro USD's daily chart. We see how the pair got some support during today's Asian and European session. It's characteristic that the pair was able to rise above their 1.0835 resistance line. That has to be turned into a support line. But the main thing about the fact that the price action has breached the 1.0835 resistance line, in my opinion, is that it seems to be escaping its sideways motion, implying that also bullish outlook is possible for the pair at the current stage. In such a case, we would be noting practically this show here as a level which would be considered the deepest trough since the beginning of August. On a fundamental level, Euro traders are expected to be very busy today. We have a number of financial releases. We had a number of financial releases already, and let's go through them, but let's finish off first of all with the chart, setting the new S3 at 1.0725, the S2 at 1.0775, the S1 at 1.0835, the R1 at 1.0885, the R2 at 1.0950, the R3 at 1.1005, locking everything in. Now, starting with the financials, or if you prefer, economic data, we started with France's preliminary GDP rate. Now, the GDP rate for Q3 accelerated if compared to the final release of Q2. Actually, it accelerated from 1% year-on-year to 1.3% year-on-year. That was a positive for the euro. Let's have a look if there was a market reaction at the time of the release. And unlocking the chart, a very small market reaction of about 2-3 pips upon the release. There was nothing much there. However, later on we got practically at 12 o'clock Germany's GDP rate. And the GDP rate was quite worrying. That's a surprise. Now, we got some conflicting messages here. On the one hand, we saw the GDP rate on a quote-unquote basis accelerating, escaping negative territory for Germany, and reaching 0.2% year-on-year. That was a positive, as practically the German economy has now escaped technical recession. And it's understandable how the pair got some support. And we tend to maintain our bullish outlook for the pair back to the daily chart. But I'm still hesitating about that. About switching the sideways motion bias in favor of a bullish outlook. On the one hand, definitely the breaking of the 1.0835 tends to highlight the bullish tendencies on behalf of the pair. And in that case, if we drill into the 1-hour chart, we could see that happening as a very slight, a higher peak one throw, a higher throw than a lower throw, that's no bullish outlook. And then we have a tear, one throw, higher throw, and rising. Okay, that's bullish, yeah. But the fact that we have 1, 2, 3, then a correction, then again, could be some bullish tendencies in play. On the flip side, though, the RSI indicator tends to advise caution. And I'm highlighting the RSI indicator rising. It's still below the reading of 50. It's actually at 40, implying that there's still a bearish sentiment, a residue of a bearish sentiment left among market participants for the pair, which could push it ultimately lower. For the bullish outlook to be maintained, we may require to see Euro USD aiming, if not testing, the R1 1.0885. On the flip side, should the bears take over, I would expect the price action to dive below the S1 1.0835, but also break the S2 1.0775, practically forming this peak as a lower peak in comparison to this one. And that would be shifting our downward trend line to the right. Should the S2 be broken, the next possible target for the bears is being set at the 1.0725. Now, as this, I would be hitting that we're getting still Eurozone's GDP rate for Q3. Now the rate is expected to accelerate both on a quarter-on-quarter as well as on a year-on-year level, which could provide some support for the euro. I would be also noting on second base also the business climate, the economic sentiment, and I would be also noting the industrial sentiment of the Eurozone. One could also mention the consumer confidence is the final reading for October, however that's not expected to change. Some slight improvement is expected in the sentiment side for the euro area, which could provide some support for the euro as well. And finally, later on, we're getting Germany's preliminary HICP rate for October. Now, the rate is expected to accelerate from 1.8% to 2.1%. Also, if realized, could prove to be bullish for the euro. So, financial data tend to imply some continuance of the bullishness for euro USD, which would allow it to move higher. Let's have a look at USD JPY. Now, USD JPY is correcting lower today. However, I would be noting that it has still not broken the upward trend line, which has been guiding it since the beginning of October. Let's have a look at the date. Actually, since the 30th of September. So the upward motion seems to continue to be in play here. Should the bulls regain control over the pair, I wouldn't be surprised to see it breaching the R154.80, and the next possible target for the bulls after the 1 would be the R258.35. Now, JPY traders, in my opinion, will be focusing on the release of BOJ's interest rate decision. Now, the bank is widely expected to remain on hold, keeping rates practically at 0.25%. That's not the question here. The big issue tends to be focusing on forward guidance should the bank remain on hold as expected. And I'm highlighting this should because I wouldn't be so certain about the bank actually maintaining rates unchanged given the uncertainty of the political, actually the fluency of the political scenery in Japan right now after the elections. We had mentioned this also yesterday, and if I'm correct, on Monday, that the fact that the Liberal Democratic Party has lost the majority, or at least its coalition has lost the majority in the Japanese parliament, highlights the need for new coalitions to be formed. And in such a case, we may see concessions being made. My main worry would be for any possible concessions related to BOJ's efforts to normalize its monetary policy, i.e. to hike rates further. In such a case, we may see BOJ facing political headwinds. And I wouldn't be surprised to see BOJ actually in tomorrow's interest rate decision, highlighting its independence from political authorities and especially the government. And to do that, it could lean a little bit further towards the hawkish side, highlighting the possibility of more rate cuts, more rate hikes to come. Such forward guidance on behalf of BOJ would further enhance market expectations for the bank to hike rates in the December meeting and could provide some substantial support for JPY, pushing USD JPY lower. That's on the fundamental side. And such a bearish outlook could be translated on a technical level by the price action of USD JPY falling, initially breaking the pre-mentioned upward trend line, exactly highlighting the interruption of the upward movement. But a mere breaking of the upward trend line would be not enough. For bearish outlook, I would require the pair to breach also the 152 support line and start actively aiming, if not reaching, as low as 149.10. Okay, let's have a look at GBP/USD. GBP/USD, which edged a little bit higher today. Yesterday. Yet today is correcting a bit lower, remaining well between the 1.3030 resistance line and the 1.2890 support line. I think that yesterday's upward movement has breached the downward trend line which was guiding it, signaling once again the interruption of the downward motion and the beginning of a stabilization of the pair. The fact that the price action respected the R1 exactly highlights that stabilization and not a bullish outlook. Now, I'm quite worried about GBP/USD, and let's have a look at the fundamentals on both sides of the aisle here. On the pound side, my worries relate to mostly the fact that UK Finance Minister Rachel Reeves is to deliver the Labour Party's first budget to Parliament, and I'm saying the first budget since it got newly elected. I wouldn't be surprised to see, say for example, the new budget including increased taxation and at the same time some cutting of spending. In that case, we may see the event highlighting some tendencies on behalf of the Labour Party's government to actually tighten its fiscal policy, and that could weigh on the pound. Now, regarding the US dollar, we have a number of financial releases which are of quite interest. I would be highlighting here the release of the GDP rate. It's for quarter 3, it's the preliminary rate, it's the advance rate. The rate is expected to remain at 3%, and we're talking here about 3% on a quote-unquote, but it's on an annualized basis. And some conflicting messages may occur here in the following sense. On the one hand, the GDP rate fails to accelerate further from 3% to move higher, say for example 3.1, 3.2%. And that's a negative for the US dollar. But on the flip side, the fact that the US economy maintains a GDP rate of 3% over quarter three, that on its own, in my opinion, is a positive. It highlights, or if you prefer, it supports the narrative of the Fed for a possible soft landing of the US economy. And that could provide to be supportive for the USD. I would be also noting that we have some other financial releases related to the employment market, specifically the ADP non-farm employment figure. It's a national employment figure. Now, many traders tend to see a positive correlation between the ADP and the NFP figure, which is due out this Friday for October. I do not. There were a number of times where practically the direction provided by the ADP was disproven by the actual NFP figure. So do not rely on it. But the ADP national employment figure tends to provide us with a pretty good picture about employment in the private sector of the US. Hence, it would be a valid indication about the path of the US employment market. And in this case, we see that the ADP employment figure for October is expected to drop from 143K, which was in September, to 110K. And definitely that could weigh a little bit on the US dollars. It would be implying that there is a loosening of the US employment market in the private sector. Okay, let's have a look at USD CAD. In a very, very steep movement, USD CAD seems to be remaining. There is a slight correction lower today, however, it's still okay. It pushed the upward trend line to the test, but in my opinion, it doesn't change the picture yet. It's a very small correction, and for the time being, it's just that, a correction. Also, the RSI indicator is above the reading of 70. It's at 75, highlighting the bullish sentiment of the market for the pair. Hence, I would maintain my bullish outlook, and I would expect the pair to breach the 1.3945, a level which provides the resistance here. And should the R1 be broken, the next possible resistance hurdle would be the 1.4115. Allow me to go back and have a look where this exactly rests. And it was on these peaks here. Okay, that's understandable. No, further. Here you go. So we have these peaks which were back in May 2020. We're talking about 4 years and 3 months, 4 months back. So that's an issue. Now for a bearish outlook, the chances are pretty slim, given that we have a strong bullish sentiment, we have an intact upward trend line, and the price action from the upper Bollinger Band still has some distance which could allow the bulls to play further. But for a bearish outlook, I would be expecting or requiring the pair to initially break the pre-mentioned upward trend line, but also break the S1 1.3845 and start aiming for the S2 1.3725. Sorry, 1.3720. So that's another issue. Be advised that today BOC Governor McClem will be speaking, if I'm correct, this time before the Canadian Senate. And I wouldn't expect much of a difference with yesterday's speech before Parliament. Overall, I would say that we may see the speech being inclined more towards the dovish side, which could weigh on the Canadian dollar somewhat further. On the other hand, I would be also noting oil prices for cut traders, given the status of Canada as a major oil producing economy. Mind you that oil prices during today's Asian session got some very slight support. And let's drill into the daily chart of WTI. You can see the slight green candlestick, nothing much. But in my opinion, the green candlestick today tends to highlight the hesitation of the bears to advance further. The release of AP's weekly US crude oil inventories yesterday may have taken the markets a bit by surprise, as AP reported a drawdown, an unexpected drawdown. And I think oil traders today will be focusing also on EIA. Should also EIA report a drawdown of crude oil inventories in the US for the past week, that could provide a double surprise for the markets and could provide some slight support for oil prices. But overall, there's very little movement in oil prices today. And that's since the start of the week. Practically, since the drop of Monday's Asian session, prices of oil have stabilized below the reading of 70. They are actually around $67 to $68 per barrel. Let's have a look at the Aussie. AUD USD correcting above the 0.6570 support line, but the bearish outlook, in my opinion, is still present. No question about that. The downward trend line is intact. The price action has not even tested it. While the RSI indicator remains pretty low, it's at 35. Despite bouncing on the reading of 30, the RSI indicator remains at relatively low levels, implying that there's still an existence of bearish predisposition of the market for the pair, AUD-USD. Overall, given that the downward trend line remains intact, I would maintain a bearish outlook. One small word of warning here. Note how the pair's price action corrected higher after hitting on the low Bollinger Band, which may slow down the bear somewhat. On a fundamental level, I would be noting tomorrow the release of Australia's building approvals growth rate. The rate is expected to accelerate from -6% month-to-month to +3%. It's a huge difference, and if so, could provide some support for the Aussie, as it would imply expectations for an increased economic activity in Australia's construction sector. I would be also highlighting the retail sales growth rate, which is expected to slow down a bit. It's the final rate. And if it slows down, that could imply some unwillingness on behalf of the average Australian consumer to actually spend more in the Australian economy. And that could weigh on the Aussie. But Aussie traders may keep a close eye also on China's MBS PMI figures, especially the manufacturing sector. The prognosis for China's manufacturing PMI figure is expected to be a very slight increase. And such a release would not change the big picture of the difficulties faced by Chinese factories to actually increase economic activity, which in turn could weigh on those, in my opinion. Or at least not provide as much of a support as it would have should it jump above the reading of 50. Once again, the bearish outlook remains for AUD/USD. We expect the pair to breach the 0.6570 and start aiming 100 pips lower the S2, 0.6470. Let's have a look at gold's price. Yep, we have a new record highs, ladies and gentlemen. Gold's price rose, breaching the 2,758 resistance line, now turned to support. And we're going to be setting as the new ultimate resistance target 3,000 round figure. It's a little bit off wide, but at this point could go even higher. Let's correct the levels. Starting with the S3, which is being now set at 2,620. The S2 at 2,685. The S1 at 2,758. The R1 at 2,830. The R2 at 2,900. The R3 at 3,000. So we maintain a bullish outlook for the precious metal. And I'm basing this bullish outlook on two factors. First is the upward trend line, which remains intact. I might even add here that the upward movement has intensified its slope. Also on second base would be the RSI indicator, which is above the reading of 70. It's actually at 71.8, almost 72. So both of these indicators tend to imply that the bullish outlook for the precious metal is still there. I'm setting the next possible target for the bulls at the R1 2,830. Let's have a look at US stock markets. Starting with Dow Jones. Okay. Dow Jones fell and stabilized. Definitely we're going to be turning this into green. Sorry. Let's complete the chart in the following sense for Dow Jones. And let's also add some resistance lines. Definitely on this peak, which is a record high. Red. And that would be the 43,380. I'm going to be recalibrating the S2, and this one could go a bit lower, somewhere here. 41,835. And I'm adding another resistance line at 44,100. Sorry, and 50. In red. Let's add some labels. R3 at 44,050. Now, as we're setting the labels, let's have a little bit of fundamental chart here. Now, there are a number of earnings releases this week. We had already Alphabet's earnings release yesterday. It was in the after-market hours. And Google's company topped Wall Street estimations. That tend to provide some enthusiasm for the share's price. I wouldn't be surprised to see it rising even further and actually providing support for the US stock markets as a whole. And overall, it's going to be tech sector this week. It's characteristic that we are getting also the earnings releases of Meta. That's today, as well as Microsoft is today. So that's an issue which is expected to continue to provide volatility for US stock markets, or renew the interest of the US stock markets. Both of the releases are to be in the aftermarket hours. And I would be highlighting tomorrow the release of, we have Apple and Amazon, if I'm correct, yeah, which could both also be market movers. So mega cap companies are going to be having the week, and given the size and the importance of these companies, I expect the earnings releases to be closely watched by every market participant out there. So for the time being, Dow Jones is expected to remain in a sideways motion between the R1 and the S1. The movement of the index over the past 5 days tends to imply it. And also note how the RSI indicator has reached and is revolving around the reading of 50, implying rather indecisive market. On the other hand, though, it may also be the case that the earnings results which are expected yesterday, which were released yesterday, today, and tomorrow, could be a game changer. And if the results are as positive as they were for example, for Alphabet, I wouldn't be surprised to see the index rising substantially. That should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Okay, let's go ahead and get started. So, for those of you guys who've just joined, today we are talking about the advanced harmonic strategy. As per usual, before we get started, a disclaimer and risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, so you should ensure that you understand the risk involved. Disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. So I'm Melanie and I'll be your speaker for today. I'm an investment analyst from Rocket, who are finalist for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We're going to do a brief recap on Fibonacci in case any of you guys weren't around for those webinars. And then we'll look at market structure, followed by an intro to harmonics, and then we'll look at the different types of patterns. So feel free to let me know in the chat if you guys have any questions throughout the webinar. And yeah, let's go ahead and get started. So firstly, let's start off with the different Fibonacci retracement levels. So these are the Fib numbers that we normally use. So you can take a screenshot here if you want. But now that we know how to draw the Fibonacci retracement trend line, which you can see in the GIF here, basically drawing from the top to the bottom, ensuring that you follow the shape of the market structure pretty closely. Okay, so then we can look at the different types of levels. So we have the levels that are ranging from minus 61, all the way to more than 100%. Why do I feel like my video is kind of lagging? Okay. Yeah. Where was I? Yes, so these are the different levels that we use, and they each have a different technique for the range. So for the negative levels, so minus 61.8 as well as the minus 27.2, we look at using Fibonacci expansions. So an expansion, I'll show you guys how we can use it in a bit. Next, we have the mid-range Fibonacci retracement levels, and those are from the 23.6 to 78.6. And then lastly, we have the levels that are greater than 100%, which would be our extension levels, and those are the 127 and the 161.8. Okay, so you can see the main three levels that I talked about in our previous slide are the retracements, expansions, and extensions. And you can see exactly how they are used in our GIFs here. Don't worry too much about this projections GIF, because we're not going to be focusing on that for now. So for retracements, it's exactly the same. You're just following from the top to the bottom. For expansions, which are the levels that are less than 100%, less than 0%, so the negative levels, you're mainly looking at finding this lightning bolt kind of shape or like a flash symbol. And then you're taking the starting point and ending point, and you are kind of projecting where prices are headed towards once price has fully surpassed that level here. Okay, so it has to surpass or retrace at least 50% of your initial trend line before you can use this expansions technique. Okay, and then we're projecting where prices will hit towards the minus 27 or the minus 61. Okay. As for extensions, we are looking for reactions off of the levels that are greater than 100%, so 127 and 161. And for extensions, we are looking for this nugget tick kind of shape. So you can see our starting point, ending point here for our trend line. Once price has fully surpassed that 100% starting point, then you can go in and use this technique. Okay, so we're basically watching for reactions off of the 127 and 161 for this technique here. Why do I feel like my video is frozen again? Can you guys hear me? Okay, I think the audio is fine. It's just the video. Um, so I'll just switch the video off for now. Oh, is the video okay as well? Okay, now it's okay. Okay, let's just move on. So if it freezes again, I'll just switch the camera off. Okay, video is stopping. Yeah, I'll just switch it off then. The next time that it freezes. So anyway, these are the different Fibonacci retracement levels if we're looking at it all at one glance. So you have the positive Fibonacci retracement levels that are greater than 100%. Over here, those are your extensions. Your mid-range would be between the 0 and 100, and your negative Fibonacci retracements, which are also your expansions, those would just be the minus 27.2 and minus 61.8. So the reason why we are going through Fibonacci first is because harmonics plays a lot into the theory um, behind Fibonacci levels. Okay, so we'll just do a brief recap on it in case there are some of you guys who haven't been with us for that long. We do have a four-part series on Fibonacci if you guys were interested on that. Um, yeah, so we go through in depth in each webinar the different types of Fibonacci's. But for this webinar, I'll just do a really quick run through of each of the techniques. Okay, so let's move on. We're now going to look at a couple of examples. So here you can see I've drawn a retracement level from this 0 to 100. My prices have rebounded off the 61.8 level. Here you can see prices are rebounding off this overlap level. So what an overlap level is basically when there are swing highs and swing lows that respect that area. We call it an overlap because the bulls and bears of your price are respecting that area. Okay, so here we can see our 38.2 prices reacting off of it. And that's also in line with that overlap level. So when you combine your horizontal levels, like your pullback, your overlap levels, with your Fibonacci levels, then it really strengthens your analysis and the chances that prices are going to rebound off those levels. Okay, so for harmonics, normally it plays off of the 61.8, which is also called your golden ratio for harmonics strategies. So the main levels that harmonics uses are the 61, 78, and also the 127 and 161.8 that we went through earlier. So the 38, okay, just give me a second. Okay, sorry about that. Um, yeah, so if you're just using Fibonacci without the harmonics, we look at all of the levels. But I just wanted to highlight, since we are talking about harmonics, 61, 78, and the levels that are greater than 100, which we'll touch on in a couple of slides. So in this slide, we are focusing on the 61.8 level. First retracement we have is this bigger one here. And you can see the 61.8 lining up with the swing high here. The second Fibonacci retracement we have is from this swing low to the swing high. Prices bouncing off of this swing low support level are also in line with a 61.8 retracement. Okay, so this shows you 61 is a pretty common level that's used to determine potential reversal points within harmonic patterns. Okay, here we are briefly touching on Fibonacci expansions. So for expansions, I talked about the flash kind of shape, or like a lightning bolt symbol. So you can see the yellow arrows kind of form that shape. So your expansion level basically traces out the start or the head of your shape. Okay, so this works especially well because you have the mid-range Fibonacci levels. Here you can see a 61.8. And you're also using the negative levels. So the minus 27.2 is where we are projecting price to come down and bounce off of. So your 61.8 is your typical retracement level that we've seen in the previous examples. And your minus 27.2 is basically where we are expecting prices to reverse off of. So you can see that's exactly what happened here. Price bounces off really nicely from the minus 27.2 expansion level. Okay, a pro tip is that price usually comes back to the ending point. Ending point is basically the first swing low of your shape. Okay. Okay, so now let's look at extension levels, which are your Nike tick levels. The yellow arrows draw really nicely the shape. You're basically taking the head of your tick and projecting prices where prices will reverse off of. So this Fibonacci extension is also commonly used in harmonics as well. So namely the 127 and the 161.8, like we see here, prices are reversing off of it. And yeah, so you see that huge reversal off of this level here. Okay. Okay, so here's a GIF that shows you how to identify the shape and also how to draw your trend line and what you can expect to see from this 127 and 161 levels. Okay, so for Fibonacci projection, I'm not going to dwell too much on this. I'm just going to briefly mention it a bit. But basically for your Fibonacci projection, we are using that same flash shape that we saw for your expansion levels, so the levels that are less than 100%. For extensions, projections, we are using the Fibonacci extension tool. So it's a bit confusing, but it's a completely different tool compared to the tool that we've been talking about for the past 3 strategies. So for this method, we're using the Fibonacci extension tool on TradingView, and that basically uses 3 points. Okay, so you can see in the GIF, we have a starting point, middle point, and ending point. And the levels that we're looking at are 61, 78, and 100. 161 if you're looking at using an Elliott wave. So ultimately, unlike the other 3 methods that we went through, this uses 3 points. So 1, 2, and 3, and you are following exactly that lightning bolt kind of shape and projecting where prices are going to reverse off of. Okay, if we look at another example of this, you can see really clearly the starting, middle, and ending points follow the swing highs and lows of price. And price has bounced off of that 100% very nicely over here. So here's an example with a very obvious zigzag or lightning bolt shape. Here you want to take note of the Fibonacci trend line that follows the market structure really closely to project the price to reach your 78.6% Fibonacci projection level. Okay, so let's see how this plays out. So you can see price has reversed off the 78.6% Fibonacci projection according to our previous analysis. Last example, take note of that zigzag shape again, of the shape. This time it's kind of inverted. So instead of being upright like this, it's upside down. Notice that there is a very clear movement in price structure, which our Fibonacci projection trend line follows. The starting, middle, and ending. And then your last part or the tail end of your lightning bolt shape follows your projection. So you're projecting where prices will bounce off of. So here you can see we're projecting prices to bounce off the 100%, and that's exactly what happened here. Okay, so for invalid Fibonacci retracements, one of the most common scenarios of this is when price makes a lower low. So that's assuming if you are drawing a Fibonacci retracement from the top to the bottom. So if there are bars on the right that break your ending point, it then becomes invalid. So there are Fibonacci retracements that are in negative that we saw earlier. But basically they go beyond your endpoint and they are still valid. So for example, here we have prices breaking below your ending point. So this then becomes an invalid retracement. So you always want to remember to pick the lowest point with nothing on the right of that ending point. Okay, now let's talk about market structure. So this is pretty important regardless of whatever strategy you are using, but particularly for harmonics because you're basically using price action. So these swing highs and lows are too insignificant. So they're bad points to use for your Fibonacci points, but they're also bad points to use for your support and resistance levels as well. Okay, so when you're choosing a chart, you can flip between the different time frames to choose a chart that gives you a really clear market structure with significant swing highs and swing lows. So you can see that the Fibonacci trend line cuts through the price structure. So this is something you want to avoid, especially when you are drawing your harmonics shapes. You want to make sure you follow price structure very closely. Okay, we saw this earlier. Okay, so let's get into our brief intro to harmonics. So harmonic patterns are pretty popular trading strategy since it involves technical analysis and it identifies potential price reversal points in financial markets. So these patterns are based on Fibonacci retracement and extension levels, which is why we went through them before going through some of these patterns. And these are basically mathematical ratios that traders believe are significant in determining potential support and resistance levels. So harmonic patterns foundation was laid by H.M. Gartley in 1932 and later developed further by many authors like Scott Carney in his book of harmonic trading. So harmonic patterns basically reflect geometric price structures. So for example, retracements, projections, and swings. These adhere to Fibonacci ratio relationships. In other words, retracement, the projection price swings that form these patterns and are interlinked together based on specified Fibonacci ratios. So the ratios that we normally use for harmonic patterns are those I mentioned earlier, 61, 78, and the levels that are more than 100, so 127 and 161. So these harmonic structures exhibit unique price structures or movements and key turning or trend reversal points. This factor is very helpful in trading as it provides highly trustful price entries and key levels for targets or stops. Unlike other trading methods, harmonic trading attempts to predict future movements, and this is what differentiates it from other indicators or oscillators, which tend to be lagging, and in terms of how they work as well. Okay, let's briefly talk about some basic pattern identification. So some of these patterns can be quite complex and a bit technical to understand, but once you understand the pattern structure, they can be spotted quite easily. So these patterns are either forming or completed M or W shapes. Or they could be combinations of M or W as well. So all primary harmonic patterns are 5-point patterns with points X, A, B, C, and D. And price swings between these points are interrelated and have harmonic ratios based on Fibonacci. Okay, so Fibonacci ratios are really helpful in trying to understand and defining precise turning points in these patterns. Okay, so starting off with the W bottom, you can see where exactly we're expecting price to break out of, where you should place your targets. For an M as well, it's just the opposite. So there are many variations of the W or the M patterns. And yeah, this is what we're talking about, the A, B, C, D, E shapes. Or it could be labeled as X, A, B, C, D as well. The main thing is that there are 5 points that are labeled on your patterns. Okay, so here's a 5-point pattern example. So all 5-point harmonic patterns have similar principles and structures, and they differ only by the ratios that are used to identify them and locate their key notes X, A, B, C, and D. So 5-point harmonic patterns have a critical origin X followed by an impulse wave XA. That's followed by a corrective wave to form the eye of the pattern at B, completing the AB leg. So basically this purple level there. And then it's followed by a trend wave, BC, and finally completed by a corrective leg, CD, that ends around the potential reversal zone. So if you look at this diagram, the levels, these like 0.38 to 0.618, these are your Fibonacci levels that we're using. So if I were to place a Fibonacci trend line here, one here and the ending point here, you can see that price has retraced 61.8% of your original line. So that's basically just what the levels mean. Okay. So here you can see projection at 161.8, retracement at 88.6, projection 261.8. So a possible pattern formation is identified after the first three legs, XA, AB, and BC are completed. So you're projecting your reversal to happen from somewhere here. Okay. So your entry level should start about past this area here. So potential trade setup is recognized as the last leg CD starts to develop. Fibonacci ratio extensions, retracements, and projections are then used to determine your potential reversal zone or your PRZ, which you can see here. This is basically your if you've been with us, the Fibonacci confluence area, this could be one of your area as well. Because you're basically projecting prices to reverse off of that area. So hit down, be attracted to the area, and then bounce off. So it's kind of that same concept. So all harmonic patterns have a clearly predefined PRZ. The initiation of new trades should take place in this zone and only after price reversal pattern action. Okay, so let's start with the first pattern, which is the Gartley pattern. So it was first outlined by H.M. Gartley, and the Gartley pattern is probably the best known harmonic pattern. Structure and appearance wise, the Gartley pattern typically forms in a trending market, and it has an M shape in a downtrend or a W shape in an uptrend. Okay, so remember, because these are kind of reversal patterns. So that's why we're calling this a bullish Gartley, because it should be in a downtrend, and then we're looking for a reversal into an uptrend. Bearish because it's an uptrend, and we're looking at a reversal into a downtrend. So how it works, or the rules for a harmonic pattern, the AB leg should retrace about 61.8% of leg XA. BC should retrace 38.2% to 88.6% of XA, and CD is at least a 78.6% retracement of leg XA. Okay, so long positions should be considered after a clear bullish reversal with a stop loss that's placed below here. So you can see the PRZ happens around point D. So we're going in for a buy here, and you place your stop loss below your buy level. So target 1 for this pattern is at your 38.2% retracement of your AD. So if you draw a Fibonacci retracement here, as long as it's 38.2% above 38.2, you can place your target profit there. While target 2 extends towards the 61.8% of AD. So if price breaks out of that 30.2% retracement, then you can go in continuously for a buy towards your 61.8. So the bearish Gartley, of course, is just the opposite of that. If you're using a bearish Gartley, your short positions should be considered after that clear bearish reversal. So off of this D with a stop loss placed above the D level. Okay, again, target for this pattern is 38.2% retracement AD, while target 2, 61.8% retracement of AD as well. Okay, so the concept behind Gartley pattern is based on the idea that after a significant price move, so this huge shoot upwards, the market will retrace AB followed by another move in the original direction before completing the pattern with a final leg, which is your CD. And this ends at a Fibonacci retracement of your initial A move. Okay, so once you understand, it's pretty straightforward. Okay, now let's look at the next pattern, which is your bat pattern. So the bat pattern is typically considered to be the most accurate pattern. In terms of structure and appearance, it's pretty similar to your Gartley, but has a different Fibonacci ratio. Also has an M shape in a downtrend or a W shape in an uptrend. Okay, so the main rules of the bet are AB can retrace between 38.2 to 50% of XA. BC can retrace between 38.2 to 88.6 of AB. And CD can retrace up to 88.6% of XA. CD leg can also be an extension of between 161.8 to 261.8 of AB leg. Okay, so your completion D typically will lie about 88.6% retracement of your XA leg, like we see here. Okay, so for long positions, you can consider them if we're looking at bullish bet, long positions would be after that D level. So you place your stop loss here. Your potential reversal zone will be this purple highlighted point, and prices are headed upwards, so you can place your take profit. Again, 38.2 retracement of this level, AD, or 61.8 as well. Stop loss will just be placed below here. Similarly for bearish bet, prices heading downwards, your stop loss will be up here, somewhere here, and you're heading towards 38.2 or 61.8 retracement of your initial leg, which is your XA. Okay, so the difference between bet pattern and Gartley is that the bet pattern emphasizes a deeper retracement in this AB and also a shorter extension in the CD leg compared to Gartley. So it's also considered to be more reliable than Gartley due to this deeper B retracement, which also allows for better risk to reward ratio. Okay, any questions so far? Okay, if not, let's move on to the next pattern, which is the cipher pattern. So for cipher, again, it's formed by 4 price swings that's labeled as X, A, B, C, and D. This is more complex compared to the other harmonic patterns. And yeah, it also uses different Fibonacci ratios. So the Fibonacci relationship here, XA leg, which is the initial price movement, can be either direction. So here it's up, bearish would be downwards. So your AB leg after that should be between 38.2 to 61.8 of the original XA. Your BC leg is a sharp extension of AB, typically extending to 127.2 or 141.4 of the AB leg. So here you can see we are employing that Fibonacci extension technique that we used earlier. BC leg is, we talked about that already. Your CD leg retraces from your BC leg, ending at a level between 78.6 and 100 of your XC leg. So for this level, you will connect your X to your C level in order to determine whether your D is part of the cipher pattern. Okay, so this is pretty distinctive from the final leg of other harmonic patterns, such as your butterfly or your Gartley. Yes, an entry is after the pattern. Endpoints of the legs are wicks or body of candles. We normally will include the wicks as well because we are using Fibonacci levels. Yeah, so even if we're not looking at harmonics, just Fibonacci, we take into account the wick as well. But yes, entry is after the pattern. So once this pattern is completed and we start to see that reversal, then we will go in for the buy. For bullish, for bearish, here you can see, that's why we call it bearish, because once price is moved up, once it reverses, we'll go in for a sell here. Okay, so the concept behind this pattern is based on the idea that after a specific series of price movements, and you can see it's very specific in terms of the retracement levels, um, the market is likely to reverse direction. So it differs from other harmonic patterns in that the BC leg, so this one here, extends beyond the starting point of your XA leg. So it creates a deep retracement for your CD. Okay, so again, this pattern is considered one of the most accurate harmonic patterns um, with a high probability of predicting your reversals. Okay, so again, target levels you can stick to typically 38.2 to 61.8 of your CD leg here. So you place your target somewhere 61 or 38. Stop loss will be placed slightly beyond this X to protect against a false breakout. Okay, any questions? Okay, here's an example of your cipher pattern on an actual chart. So you can see, yeah. So I think if you look at it at one glance, you can't really see what's going on. So you do have to go in and use your Fibonacci retracement tool to label all of the levels, the 78.1 that we mentioned, the 127, yeah. But yes, so you can see once price reverses off of that D level, then we'll go in for a buy. These patterns can work on any chart. You can see in this example, we're looking at Euro Yen on the 1 day time frame. So I'm sure you could find it on gold as well. Although now on gold, prices are kind of moving in an uptrend, whereas these harmonic patterns tend to work better in trending markets. So, but still you might be able to find it on gold as well. So yeah, it works on any kind of chart. Okay, let's move on. So next, we're going to look at the butterfly pattern. So butterfly pattern also uses the M or W shape, but it's different from Gartley and Bett in that it extends beyond the starting point of your pattern, which is your point X. So the Fibonacci relationship, again, we're looking at AB retracing 78.6% of your initial price movement, so XA. And then for your, I talked about AB, yeah. So next is BC, and you would be looking at a 78.6% retracement, 30.2 to 88.6 retracement on your XA, and your CD would just be a 1.61. Um, Actually, these are levels greater than 100. So it'd be 161.8 to your 261.8 level. So again, here you are seeing that same Fibonacci extension level. Okay, so yeah, that's why we went through your Nike tick shape, because you can see very clearly how it would work on some patterns as well. Okay, and lastly, of course, your CD is a 127 to 161.8 retracement of your XA. Okay, so concept behind this is that it basically indicates a potential market reversal beyond this starting point. So that's the difference between godly and bad. It's also a more aggressive pattern, so it predicts a stronger reversal. So it's based on the idea that the market often will overextend beyond the initial impulse move, which is your XA, before it starts to reverse. Okay, we have a question. Are the patterns best seen on daily charts? It kind of depends on your trading style. Um, we normally will use this on either daily or for 1 hour or 4 hour time frames. So we normally won't go anything below 15 minute. I think 30-minute works as well. But anything below 15 minute tends to get a little bit harder to analyze because charts are noisier. Yeah. So normally 30-minute, 1 hour, 4 hours, or daily works as well. Okay, but generally your harmonic patterns increase in reliability with higher time frames because they are less influenced by, your short-term fluctuations and market noise. So that's why we normally use 4 hours or daily. Okay. Lastly, or not lastly, but we are going to look at the crab pattern. So crab pattern was actually released in 2001, and this is a pretty extreme pattern as well because the corrective wave, your AB, should end between 38.2 and 61.8. Okay, so for the Fibonacci levels, you're basically looking at XA as the initial price movement again. AB is the retracement of 38.2, 61.8, as I mentioned. BC is 38.2 to 88.6 of your AB. CD is just the defining feature of your crab pattern, um, which is an extreme extension of the XA leg. You can see it's 161.8. It can actually go even higher. So if you look at your BC extension, here if you're using the Nike tick method that we used earlier, you'll be looking at somewhere between 224 to 361. So this is the defining feature of your crab pattern. Okay, so this pattern was discovered by Scott Carney, and it's considered one of the most accurate harmonic patterns as well, simply because of this deep extension of the final leg. Okay, so yeah, this is I think it's the largest extension, especially for the last leg here. Okay, Next, let's look at the shark pattern. So this pattern is relatively new, also introduced by Scott Carney. This pattern is unique because it doesn't follow that traditional XAB CD structure that we've seen in the other harmonic patterns. Instead, it uses a 5-point structure that's labeled OXABC. So it's known for its sharp price patterns or price movements and the ability to identify potential reversal zones before the final point of traditional patterns. So structure and appearance-wise, it's characterized by this steep OX initial move, followed by a sharp retracement of your XA, deep extension, again your AB, and another retracement BC, which is considered a continuation or a reversal pattern depending on where it forms in the trend. So in this example, we are using it as a reversal. That's why you can see price after the completion of the shape. We are projecting it to reverse. But if you found it somewhere between the BC line, of course, you'd be expecting a continuation. Okay, so the strength of shark pattern is that it is able to identify potential reversals earlier than the other patterns, such as your crab and your bat, because you're looking at this price pattern before its completion. So you don't have to wait for your C level to form before going in for your trade. Reason being, your BC level is so long, so if it doesn't fall within this 113, you can just assume that prices are going to continue. Once it hits or it falls anywhere between 113 and 161.8, projection of your AB, then you can go in for a buy or sell if you're looking at the bearish shark pattern. Okay, so the target profits, where you should place your target profit and stop loss, for all of these patterns lies about 38.2 to your 61.8 retracement of your this final line here. And then your stop loss would just be outside of that initial line. Okay, now let's look at the advantages and disadvantages of harmonic patterns. So harmonic patterns provide future price projections and stop levels in advance and are considered leading indicators. They're frequent, repeatable, reliable, and produce high probable setups. And the trading rules are relatively standard since they're using Fibonacci ratios. And they work on all time frames and on all market instruments. Other momentums, other momentum indicators like your CCI, RSI, MACD, DMARC, and so on can be used along with them as well. Some disadvantages: harmonic patterns are complex and highly technical to understand. Correct identification and automation or coding of harmonic patterns is difficult. Conflicting Fibonacci retracement and/or projections make it difficult to identify the reversal or projection zones, and complexity arises when we get opposing patterns from different time frames. So the risk-reward factors from some of the patterns are also pretty low. And yeah, that's all I have for you guys for today. Let me know if you guys have any other questions. But if not, thank you guys so much for joining me. I hope you guys found this session helpful and have a great rest of your week. And if you guys like me, feel free to connect with me on LinkedIn. It's just my name, Melanie Chong. And yeah, I'll see you guys again next week. Thanks, everyone. Bye.